Okay, thank you everyone for joining this month's monthly recap on moving markets. I'm joined today by David Sokolovsky, wealth advisor with the team. David, let's talk about the month of November, sort of a tale of 2 months. How do we look at it?
Yeah, Jared, I think if you look at the month of November and really break it down, it was the story of the first 3 weeks and then the story of the last 3 days. And so if you think about the first 3 weeks, it was really the positivity driven by small companies and generally company earnings. So companies that have reported have been positive across various different industries, ranging from consumer focused industries to home builders and commodities. If we think of the net effect of the two in the last couple days of the year, it was really a sell-off driven by concerns around the most recent COVID variant, as well as some of the commentary that came out from the Federal Reserve in the last day of the month. And ultimately, as we look at the month, some of the larger companies ended the month in positive territory, whereas smaller names that had a larger sell-off, and even the bond market recorded losses for the month. So I guess the question to you, JR, is this trend going to continue from the last 3 days, or are we looking at something more positive like the first 3 weeks of the month?
Well, the big news from the Fed is interesting to follow because we've been saying this for months that inflation is not transitory. And for the Fed to finally acknowledge that inflation is not transitory and might need to taper faster, which could lead to interest rates rising sooner than they had predicted before, is an overall positive sign as we look out a few quarters. Near term, the markets are never going to like that, where you're taking that liquidity, that optimism from all that free money out of the system. But the concern none of us want as consumers, investors of the overall economy is an uncontrollable inflationary environment. So for the Fed to finally be a little more aggressive to that, yes, it could be a little bit of short-term pain to the markets, but it's for the multi-quarter optimism and stability that should follow. And as we look at kind of recapping, now that we've pretty much through the earnings season, it's interesting to look at profit margins, which is an interesting data point. Profit margins were the highest level since 1950. If you think about that, it's a long time, over 70 years. What's driving that, David?
Well, I think a lot of what you're seeing in terms of profit margins are what do you see in the short term versus the long term. So in the short term, for example, we've seen consumer prices go up across various different industries. You see price increases, and the overall level of inflation is about 6%. So during that time period, companies have been able to raise their prices and have met the demand of consumers. But as you think about longer term and what does it mean for companies to catch up and what for their profit margins, is that once you lock in these increases in salaries, we've seen record bonuses this year, those salaries next year are going to continue to eat into profits. And we've also seen the cost of logistics. So for example, earlier this year, a container ship, which may have cost about $2,000 per container, is now at about $10,000. That's also going to continue to eat into the profit margins. But the positivity, I think, is still there in terms of the strength of the consumer and the demand.
In looking into next year, let's talk about some of those other optimistic points. The consumer's in good shape. What else looks fairly good as we look into next year?
Yeah, so I think if you look at both companies and consumers, they're in great shape. They have the strongest balance sheets that we've seen in a long time. In some cases, better than in any time in history. So you see the consumer has built a safety cushion in terms of their savings, in terms of the equity in their portfolio, in terms of the equity in their home. You see the same thing with companies that have been able to pay down some of their debt. And so that strength of the balance sheet, I think, is going to be very important. I think the other thing to take a look at is the housing market. That's an area that continues to remain strong. Prices are up significantly from last year, but the rate has slowed, but the demand remains there. So the consumer is in great shape, still continuing to buy housing. And then all of the other industries that are impacted by that. If you think about buying a home, you then have to do some kind of work on it. You make updates, you change it to the way you like, you buy furniture. All of that has a downstream effect on the economy. And I think lastly, and the one thing that we didn't spend much time on today, is the infrastructure bill. So that was officially signed by the president this month. And so that's going to provide $1 trillion worth of demand for infrastructure products over the course of the next 5 years. Some of the, or at least to be rolled out in the next 5 years, a lot of the spending. And so that's going to provide some additional tailwind. As far as some of the drawbacks and things that we're seeing or areas of concern, I don't know if JR, if you want to touch on that.
Well, as you kind of look into the last 3 years and what's ahead, there's definitely a reason to be optimistic looking into 2022. But looking at the last 3 years, backward looking, it's been pretty easy from a rate of return standpoint. Clearly, it hasn't been that as we've all lived through the ups and downs and all the health concerns around the COVID concerns that are still out there. But backward looking, the markets have pretty close to 15-20% returns per year the last 3 years. If you look in 2022, it's just not likely going to be that type of investing environment. There's reason to be optimistic, but I think expectations should come down to that middle to single digit return environment next year. Just given, I mean, historically, we've always followed the Fed. The Fed is entering a cycle where they're telling you to take a little bit less risk because they're pulling money out of the system and raising rates. So we'd expect it to be a little bit more of a challenging investing environment as we look into next year. But as always, as conditions change, we'll adjust along the way. So with that, we want to thank you for tuning in today, and we'll touch base next year.
Thank you.